Alright guys, so let's talk about the land of the rising sun. Japan is in big trouble. For over 2 decades, the Bank of Japan has been printing endless amounts of money to prop things up. The BOJ have been buying up tons of government bonds since 2013. It went from 80 trillion yen to 600 trillion yen. The goal was simple: keep interest rates as low as possible. That way, you force people to spend more money to stimulate the economy. It worked for a while, but this scheme is unraveling fast. When the Fed started hiking rates, it signaled disaster for Japan. And here's the issue: because rates in the US flew up, and Japan can't afford to hike without blowing up the debt, money is leaving Japan and their currency. The Japanese yen has been imploding. Investors and people are dumping it like no tomorrow. If we compare the yen to other global currencies, it's a horrible bloodbath. The yen has lost over 12% of its value this year versus the dollar, worse than the euro, the Turkish lira, and even the Argentine peso. Imagine that even countries like Brazil and Argentina have a stronger currency than Japan. Japan, which is supposed to be a highly developed country, this is absolutely crazy. The yen is now at a 38-year low, which is a historic collapse. We're well over 160 yen to the dollar and it's going to get worse. Be prepared for 170 or even 180 because the establishment is trapped. And there are a lot of serious problems with this. The first is obviously higher inflation. Japan is an island nation, so they import a ton of stuff into the country. They are not self sufficient at all. Over 60% of Japan's food is imported, and for fuel, it's at a crazy 97%. So when the yen starts to crash, real inflation for everyone in Japan starts flying to the moon. As a worker in the country, your real wages after inflation fell by almost a percent in April again. In other words, you are getting poorer every single month just slogging it out in Japan. This has happened for 25 months in a row. The standard of living in Japan is dropping, which is a reminder of how important a stable currency is. We constantly hear threats from the BOJ that they'll get tough on the currency, but there's nothing Ueda can do to save the yen. They tried massive currency intervention, they tried raising rates, but nothing worked. And because of this, Japan's economy is moving towards true stagnation. There's a big misconception that a weaker yen is great for Japanese companies, especially their manufacturers. And here's how the conventional wisdom goes: the yen has collapsed by over 20% since the rate hikes. So Japanese goods are now 20% cheaper when sold in US dollars, and that makes their exports cheaper to the world. In that case, Japan could steal more market share from other countries. Their exports should be booming, but that isn't the case. Despite the falling yen, Japan's exports contracted by almost 1% because demand for Japanese goods just isn't there. When the yen collapses, it drives the cost of manufacturing for Japanese goods up as well. The overall price tag isn't dropping fast enough. The country simply imports too much from the world. Let's remember that Japan is no longer a net exporter. Since 2011, the trade deficit has been getting progressively worse. In contrast, Japan's biggest manufacturing rival is eating up their market share. China is now officially the world's biggest car exporter, beating Japan's numbers by over 100,000 cars. Even though the yen is getting cheaper than the yuan, more Chinese cars are being exported out. Consumers are choosing Chinese EVs over Japanese brands. And how is this even possible? It's quite simple. China has integrated supply chains and cheap energy from Russia. And that is an industrial advantage that is built on solid ground. It's really something that you can scale out. You can't scale a collapsing currency, it will just lead to widespread poverty. Another big edge China has over Japan is lesser reliance on the US dollar. And this is something very important we must talk about. China can sell their goods and buy their imports using their local currency with all their trading partners, but Japan exports and imports only in dollars. This chart shows us how far China's de-dollarization has come. China's trade used to be predominantly in the dollar, like every other country in the world. In 2010, 83% of cross-border payments were done in USD. Fast forward today, it's only at 42%. The majority of transactions, 53% worth, are now done in the local currency, the Chinese RMB. This allows China to insulate itself from any sudden shortage in US dollars. Even if the Fed hikes interest rates, suddenly Beijing can still conduct trade without scrambling for the reserve currency. That isn't the case for Japan. Their trade revolves around dollars. Input costs are going up and the cost of living is soaring. The BOJ has put the country in a position where they can neither advance nor retreat. And here's what we mean. Japan has lost control of their exchange rates. Why? Because they need to maintain the free flow of capital for their exports. They also need to keep interest rates low or their debt will explode. Hiking rates can also collapse the real economy that is so used to cheap money. Because of that, the only release valve for this pressure is the Japanese yen, the exchange rate. This is what happens when you keep buying endless amounts of bonds. Unless the BOJ decides to let rates rise and just blow up everything, the only outcome left is further devaluation of the yen. This is where Japan is boxed in as well. They have been selling billions of dollars in the market to prop up the yen, but nothing is working. Their efforts have been in vain. A month ago, Japan spent nearly 10 trillion yen to support their currency. That's around $62 billion thrown to the wind. It's a delayed tactic to postpone a total collapse. Since the Fed started hiking rates, Japan intervened at least 3 times, but they just don't work. Within a few months, the yen starts to depreciate against the dollar again, and the whole process repeats itself. Japan is peeing into the ocean hoping for the water level to rise. They are plugging holes in the Titanic after the iceberg has hit. It's simply too late now. So you would think that the US would rescue their ally. The fastest way to plug this hole is for the Federal Reserve to inject dollars directly into Japan through their currency swap line. The US has an unlimited standing facility with their G7 allies. This includes the UK, Canada, and of course Japan. So the Fed can always swap a bunch of Japanese yen for US dollars. That will help to reverse the yen's collapse. You get liquidity straight from the printing machine itself. Japan won't need to sell their US treasuries and deplete their reserves, but that isn't happening. Activating the swap line is essentially a QE for Japan. It's money printing all over again, which will reignite global inflation. To add insult to injury, the US added Japan to their currency watch list. That's one step away from being labeled as a currency manipulator. And if that happens, US sanctions could follow. So there's also a limit to how far Japan can defend their currency. They will have to ask for permission from the US to save the Japanese yen. This is hilarious and very sad and humiliating at the same time. Yellen has made it very clear to Japan that intervention has to be rare and shouldn't be used routinely. Japan can't keep burning through their dollar reserves either. The US won't allow it. To raise the money, the BOJ will have to sell their treasury bonds, and it's very obvious that the US doesn't want that to happen, at least not in large scale quantities. So Japan is left with a crashing yen and very few options. They are stuck with a crisis that's escalating every single day. A big flashpoint is the banks in Japan and all their risky bets. A week ago, we saw Norin Chukin Bank admit to major losses from their investments, and we have no idea how deep this rabbit hole goes because Japanese bonds yields almost nothing. Investment managers have to venture overseas to chase yield, but the trade has turned and the bleeding is getting from bad to worse. Norin Chukin was borrowing US dollars through short-term bills to invest into longer dated US bonds. For a while, that was working like a charm. Their cost of borrowing was only 0.5% at most, but funding costs are 10 times higher, more expensive, hitting well over 5% now. And this is happening across the entire of Japan. It's virtually impossible to do this carry trade any longer, which is pushing investors towards more dangerous products. And the next shoe to drop might be the Japanese stock market itself. In 2023, Japan's pension giant GPIF brought home a handsome return of $230 billion. But where did those gains come from? The majority came from Japanese stocks, and here's the problem. Stocks are extremely volatile, we all know that. And because of the weak yen, investors are starting to flip. The weaker the currency collapses, the worse it actually gets for the economy because people simply consume less. The Japanese consumer is not the same as people in the US. When people in Japan lose buying power, they tend to save money more. Consumer spending starts to crater and the economy contracts. Let's not forget about the horrible state of Japan's GDP figures. In Q3, we saw almost negative 4%, Q4 was flat, and last quarter saw the economy contract by 2%. Sooner or later, this is going to translate into poor company earnings and a falling stock market. The rally we saw was fueled mainly by the cheap yen, but the currency is getting too cheap to the point it's becoming detrimental. And now foreigners are dumping their Japanese stocks. The cheap yen is no longer supporting this rally that isn't built on real fundamental growth. Foreign investors are dumping their yen denominated stocks. People are selling their holdings for 5 straight weeks, and the further the yen crashes, the deeper this sell off will get. The cheap yen magic is wearing off now. Imagine you're a foreign investor. Japanese stocks might climb another 10% from today's levels, and that's great news. But if the yen collapses against the dollar by the same amount, 10%, your gains are wiped away completely. People are beginning to smell the coffee now. They realize that this is one big house of cards. If stock prices continue to slide, we could see pension funds in Japan get into real trouble. And if things get bad enough, money could come flooding back into Japan to stem the bleeding. And this brings us to two deadly realizations that Japan's demand for US treasuries will be gone for quite some time. They simply can't afford to buy anymore. It's not because Japan hates the US, it's because their currency is really collapsing. They might even sell more of their holdings to shore up the yen. Secondly, the situation can always happen in the US as well. Japan increased their debt to the point they simply can't maneuver anymore. They're out of options. The US debt today sits at around $34 trillion. It's 6 trillion more than the US GDP, and that's a really big problem. As China, Russia, and the global south keeps de-dollarizing, this pushes the US towards a Japan situation. We aren't quite there yet, but the debt situation in Japan is a great reminder to everyone. Fiscal spending in the US has to come down or this will end in disaster. But let me know what you think. Can Japan rescue the yen? Or is it all over, game over for Tokyo? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.